trading family, welcome back. It's a Monday that feels like a Friday hangover with missiles in the tape. I'm Wildcard, and I've got TB locked in next to me.
Good morning. Quick reminder, nothing we say is financial advice. We're just two traders making noise, not telling you what to do. Do your own work, size your own risk, and know your stops before the open.
The tape is a mess. Futures are trying to find a floor, SPY futures are flat to slightly up. The Q's deeper red, down about 5.3%. VIX at 19.89, and here's the twisted part. It's showing a negative 7% change pre-market, while equities are bleeding. Oil at 94.78 because Iran and Israel traded strikes over the weekend. And the Kospi in Korea got halted down 8.29% overnight. That's not a red open. That's a test of whether you've got a plan or you're about to learn why you needed one. Cash is a position until the first 30 minutes. Tell us if we bounce or the floor falls out. TB, what's the one thing on the tape that scares you more than the rest?
The bond market. Normally, when missiles fly, treasuries rally on a flight to safety. Yields fall. Instead, the 10-year is up, yields pushing higher. Bonds are selling off during a war. That's the macro trap. Strong jobs data. Friday means the Fed can't cut. Shipping costs spiking from supply chain chaos adds inflation pressure. Barclays back in May warned a rates shock would kill artificial intelligence capex dreams, and now it's happening. Franklin Templeton SIO called artificial intelligence investment inflationary, not disinflationary. So the Fed is stuck, and long-duration assets, tech, semis, anything with multi-year earnings, are getting repriced first. That's why the Qs are down nearly 5% from Friday. This isn't a rotation. It's structural.
It's hitting my TFT algo like a wrecking ball. AMD, down 11%, sitting at 465. Broadcom blew through my stop at 435 and now trades at 391. ENPH at 57. That's not a dip. It's the duration math TB just described. And the DRAM ETF crash from 3 weeks ago was the canary. The supply chain was already cracking before the missiles flew. Now war is the accelerant, the Kospi halt. That's forced selling. Margin calls in the most levered retail market on the planet. Those halts didn't finish the selling. They just paused it. The overhang lands on our open until Kospi stabilizes. Any bounce here is a dead cat.
And there's the VIX trap. The VIX is dropping 7% pre-market while the market is set to gap down. Someone is selling volatility into this, betting on a bounce. If the bounce comes, they win. If we open down another 2 or 3% and the VIX finally catches up, it'll race to 25 in minutes. At that level, systematic deleveraging hits. Risk parity funds, full targeting strategies all sell. That's the moment the pullback becomes a real correction. I'm watching VIX, not SPY, in the first 30 minutes. The fear gauge is lying right now.
So we're staring at a potential cascade. Let's hit the calendar before we go deeper. Earnings this week.
Actually, there are a few notable earnings: Campbell CPB, FuelCell FCell, and others. We should cover them.
Done. Economic calendar is all that matters. Wednesday brings the N5 small business optimism, which nobody cares about until Thursday. Thursday morning at 8:30 is core CPI. Consensus is 2.9% year over year. If it beats, the 10-year yield breaks 475 and tech takes another leg down. If it misses, we get a dead cat bounce into growth. The whole week is positioning for that one print, plus PPI right after. But CPI is the line in the sand.
And right now, the rotational flows are already telling you the market's bracing for the worst. The energy sector ETF energy is up over 2%. But it's not the only positive sector. XLVelf Healthcare is up 2.37%. And XLRay Real Estate is up 1.61%. Healthcare and real estate are holding. Technology and consumer discretionary are getting shelled. Money is hiding in oil, hospitals, and properties. Anything that isn't growth. Oil at 94.78 with Strait of Hormuz risk makes energy the only reliable bid. But there's a hidden tax that's flying under the radar: shipping costs. Container spot rates are spiking double digits on Middle East disruption. HSBC's CEO warned about client behavior. The Philippines put out a foreign exchange risk alert tied to freight. That supply chain repricing hasn't shown up in consumer earnings yet, but it will.
I want to bridge that straight to the international plumbing. The Kospi halt isn't just a Korea story. It's a margin cascade that feeds our futures. TB, break down the mechanics for the family.
South Korea's retail base is deeply leveraged and concentrated in artificial intelligence supply chain names: Samsung, SK Hynix. When those stocks drop double digits in a session, margin calls sweep through. The exchange halts to stop the free fall, but the forced selling gets delayed, not eliminated. That overhang rolls straight into us futures at our open. It's a contagion loop. Us tech drops, Asia supply chain sells off, that selling pins down futures, and that pushes us tech lower again. Until the Kospi holds a level, any bounce here is a dead cat. Used PI and China are quiet, but the real story is this margin fire sale rolling from Seoul to New York.
That loop brings us straight to the hottest theme touching our book right now, the artificial intelligence CapEx unwind. TB, give me the whole story. Drivers, bull case, bear case, second order effects.
The drivers are clear. Higher for longer rates destroy the net present value of multi-year artificial intelligence spending. War adds supply chain cost inflation, from shipping to energy to hardware components. Those two forces compress ROI expectations for every data center, every chip factory. The bear case says we're in a period of overinvestment, CapEx is surging, margins are getting squeezed, and the market is repricing that risk. The bull case says artificial intelligence demand is real. TSM CEO confirmed their capacity constrained for years, and this is a long-term secular trend. But near-term, valuations haven't repriced for interest rates staying above 4.5%. Second order, semi-equipment gets hit, cloud names wobble, data center REITs feel it, energy costs eat margins. My wave trader algo is holding a broad book, but I'm light on semis. My gut call paper account has OXY at 57 with oil at 97. A non-correlated energy play. My stop is at 54.
My TFT algo is down 4,000 in unrealized losses across 11 names. ENPH from 68 to 57. AMD from 511 to 465. TSM is still holding at 420, but I tightened its stop to 400 this morning. The capacity constraint story is either a floor or a trap if the artificial intelligence narrative cracks. My paper account is heavy cash, 7,000 sitting ready. No new callouts. The bear case is winning for now, but I'm not selling into panic. I'm letting stops do their job. OXY is the only name in my watch that I'd consider holding through CPI if oil stays bid.
Watch those levels. Tomorrow, SPY must hold 730. The Qs must hold 695. If those break, this pullback becomes a 10% correction. I'm watching VIX. If it creeps above 22 in the first hour, the floor isn't in. If it jumps to 25, systemic deleveraging triggers and I'm out of the way. Oil, if a Strait of Hormuz headline hits, $100 happens this week. My gut account OXY flag is my bet on that asymmetrical risk.
So, here's what we're watching tomorrow, Thursday. CPI. Core 2.9, the decider. SPY support at 730. Qs at 695. VIX above 25 equals selling everything. Oil at 100 if supply disruption escalates. And, above all, check your stops before the open. Cash is a position. Sizing for Thursday, not heroics. Trading family. Protect your capital. Don't let the fear gauge lie to you. I'll see you on the other side of the tape. TB, tight show.
Tight show. Stay frosty, everyone. CPI. Thursday is all that matters. Good luck.